Hi, everybody. I'm Dominic Smith, one of the organizers of this series, along with Raphael Schunla. Thank you for coming to this session of the series sponsored by SEBRA and the Federal Reserve Bank of Cleveland Inflation Center. And without further ado, let me hand this off to the moderator, Hugh Montag from the Bureau of Labor Statistics, who will discuss the format of the seminar and introduce the speakers. Take it away, Hugh.
Thank you. The topics of today's sessions are the market for inflation risk and monetary policy in the age of social media, a Twitter-based inflation analysis. I'd like to offer a special thanks to the two organizers, Raphael Schunle from Brandeis University and Dominic Smith from the Bureau of Labor Statistics. The structure of this webinar is that it will be 45 minutes with two presentations that are each 15 minutes and a 10 to 15 minute Q&A at the end. Attendees do not have the option to turn on their audio or video, but are invited to write comments or questions in the Q&A space. Attendees can post their questions during the presentations as they're going on, and they don't have to wait until the end of the presentations. And then after the presentations, I will select questions to be answered from the Q&A portion of the webinar. This webinar is also live streamed via SEBRA's YouTube channel, recorded and made available on SEBRA's website, www.sebra.org, and it will be on SEBRA's YouTube channel after the event. Finally, a short disclaimer. Participation in a SEBRA webinar does not constitute or imply an endorsement, recommendation, or favoring endorsement of the views, opinions, products, or services of the Central Bank Research Association or any other participating institution, individual, or entity. All views expressed during a SEBRA or SEBRA-hosted event are strictly those of the authors, discussants, and other participants, and not those of SEBRA, the co-sponsoring institutions, or any other participating institution. Okay. Now, without further ado, first is Ricardo Reis, the A.W. Phillips Professor of Economics at the London School of Economics, who will be discussing the market for inflation risk.
Thank you. Let's see if I get my slides on. And there we go. Oh, no. What did I do? Great. Thanks so much for having me. Pleasure to be here. Just confirm you see my slides, yeah? Yes. Okay, great. So this is joint work with Salim Bahaj, Rob Check, and Sitong Deng. And what we're going after here is the fact that I've been, and I'm not the only one, several people, Raphael, is one of the leading people doing this work. I've been trying to measure expected inflation for a very long time. And one very popular, for good reasons, measure of expected inflation is look at the prices of inflation swap contracts. This is a contract whose price goes up when inflation realizations go up. And as a result, when we can stare at the prices of these, they give you an exact market measure of whether people expect that inflation to rise or not. These are heavily traded, very liquid, used by many to insure against inflation and also speculate against inflation. And so no self-respecting central bank, I think I can say this at SEBRA, does not have at least one staff member that produces a version of this picture every day, if not even every hour, and make sure of what's going on, both at short and long horizons. The novelty in our paper is that we, I think, are one of the first to have access to the almost full universe of the trades behind these prices. And in doing so, we can therefore look at the Q behind the P. So we have the quantities behind the prices for the UK since roughly 2019, and we can say who buys and sells these, and therefore whose expectations are these of this one market price that one observes. So what I'm going to do today is show you some facts about that market. Those facts are going to suggest a particular identification strategy for some objects we want to measure, and those are going to lead to some results. Fact one. It turns out that in this market, where you have dealer banks selling inflation insurance in the form of these swap markets, and on the other side, a series of people that can just walk into a dealer bank and try to buy one of them, this is not a market where the dealer is, as one thinks of dealers, taking some guys who want to buy, taking some guys who want to sell, and keeps a neutral position, but rather, dealer banks hold a very large position on net, 120-ish billion US dollars in the UK market. That is, to be more accurate, they're not dealers, they're insurers. They sell insurance well beyond their holdings of index government bonds. They sell insurance against inflation risk. Who buys insurance? Well, if you look at the long run, who's buying, who's on the other side, with the dealer banks being on the negative, if you want, are, for the most part, indeed, almost exclusively pension funds. Pension funds buy insurance against inflation, sold by banks. Why? For good reasons. Pension funds want to insure against the inflation risk in their pension obligations. If you look instead at the short horizon contracts, 3 years and less, the first thing to note is that whereas there's a large net position here, 100 billion at its peak, here the positions are 1 order of magnitude smaller. And here what you have is that the dealer banks are on the other side of mostly hedge funds that sometimes are buying inflation, selling inflation protection, sometimes are buying inflation protection. And so it's hedge funds that dominate this market. Pension funds are very inactive here. And at the same time, hedge funds are barely at all in the long run market. Therefore, there's a clear segmentation. Financial economists have for many years been studying segmented financial markets. And here is an example of a market that is probably as or more segmented than any that I have ever seen. In the long term, and this is instead of positions now, stocks, these are flows, trading activity. In the more than 10-year, you look at the flows and it's dominated by pension funds. In the short horizon, it's dominated by hedge funds. Now, let's use the facts of the segmented market to basically in this paper, we try to show how to identify supply and demand and fundamentals in segmented markets. Think about the long market. We have a demand from the pension funds and a supply from banks. When expected inflation goes up, the expectations of the banks go up, the expectations of the pension funds go up, and we have a new price for the swap, and therefore we infer expected inflation has gone up. We struggle a little bit to know whose inflation it is. Well, it's a mix of all of them who went up. So far, so good. Swap prices go up when expected inflation goes up. However, if the pension funds, because of their mandate, have some background risk, have some trading constraint, and instead, for whatever reason, they start demanding more inflation protection, you're going to have that there's an increase in expected inflation or an increase in the swap price with no change in the expected inflation at all. Likewise, banks may have a series of regulatory operational reasons that mean that the swap price will go up even though expected inflation didn't change. So the expected inflation measure is going to be very polluted by all of these liquidity shocks, let me call them, following a long tradition in finance, i.e. something that is not fundamental. However, because I know these markets are segmented, I can do something about it. Namely, if there is a shock to the supply of banks, that will move prices in both markets. Whereas a liquidity shock to, say, the hedge funds, moves prices and quantities only on one of the markets rather than the other, which gives me hope to be able to separate liquidity from fundamentals in driving swap prices. Namely, we want to separate fundamental shocks to inflation from liquidity shocks to hedge funds, pension funds, or banks. The literature so far has had two prices, that of the short and the long inflation options, to identify these four, and so it was a hopeless task to separate liquidity from fundamentals. Our first contribution, of course, is we have data on the prices of both the short and the long swaps. But that's not enough. That at least puts us in the game. We have 4 observables and 4 shocks. We still need to identify how do these shocks translate into the prices. Luckily, given the segmentation, we say, let's propose 3 novel identification strategies to identify segmented markets. First, heteroscedasticity. At some dates, imagine fundamentals are much more volatile than liquidity shocks. If that is the case, by heteroscedasticity, we could identify the fundamentals. Well, it turns out we can. Why? Because plausibly, at the dates in which CPI is released, those are the dates when you learn about what actually inflation was, contracts get paid, and so that satisfies the thing for heteroscedasticity. Second, this market turns out to be massively granular. The Pareto, the power law coefficients are close to 1. They're close to Zipf's law in terms of how big a few hedge funds, a few banks, a few pension funds are. Because of that, we can build a granular IV, namely look at individual shocks to these very large players and then use them as instruments, as shocks to liquidity that are not shocks to fundamentals. And third, insofar as it seems very plausible that at high frequency, the hedge funds are much more responsive than pension funds, and that there's no supply spillovers between them, what that means is that we're going to have a sign identification in terms of how prices and quantities move that allows us to identify the system. Very reassuringly, surprisingly, very strikingly maybe, this may be the most striking result, is that I have 3 identification strategies, completely separate. This uses the time series variability in the data. This uses the cross-sectional variability in the data. And this uses the the heterogeneity in responses across markets, completely different source of variation of the data, and yet all three give me the same fundamental shocks. The correlation of the fundamental shocks identified the three ways is the same. And moreover, we can do this thing that I think is novel to economics, although economists are going to hate us if referees start asking for this, which is that I can use two of the strategies to see whether the identification assumption of the third strategy holds, and do that for all combinations of the three, and it's the case. That is, shock identification elasticity satisfies the granularity assumption, and so on, which means that you may not like each of these strategies individually, but this is pretty strong evidence that we're getting something right or something that's consistent. What are the results then? Result number one, we can identify supply and demand in this market. When you look at the short-term market, the supply function is upward sloping, demand is downward sloping. But when you look in the long market, the supply function is remarkably flat. There's something about the AO of this market that means in the long-term market, the banks essentially make take it or leave it offers. Here's the price. And the pension funds take it. Whereas in the short-term market, there's a negotiation, supply and demand slope up and down, and a price is found. Something to hopefully inspire researchers who study the microstructure of these markets and how bargaining happens. Result number two, but a consequence of this. If supply is horizontal, that means the shocks to demand have no impact on price. And therefore, liquidity shocks to pension funds have no impact on expected inflation in the long run or the price of the swaps. And so when you do the variance decomposition on the long-term prices, there's basically almost no impact of the demand shocks. It turns out that also with the horizontal demand, liquidity shocks are movements along the curve. In other words, on the long-term price, something like 3/4 of the variance in the price is the fundamentals. Whereas in the short-term market, most of the fundamentals only explain about 20% of what you see in the price. Most movements in short-term expected inflation up to 3 years is noise, liquidity. Most movements in the long term is fundamentals. Third, having done this, I can separate it. Red are the actual 10-year long-term prices. Blue is my new cleaned of liquidity fundamentals, expected inflation. So we hope that central banks will start looking at the blue line. Right now, they have someone looking at the red line every day. Start looking at the blue line, the one that's cleaned of the liquidity shocks. Here, again, the blue is 75% of the variation of the red. What do you see this, and then we zoom in the paper on a lot of different episodes, is that the actual usually over amplifies what the counterfactual is. That is, that liquidity shocks in the sample have tended to be positively correlated with the fundamentals. That is, that when expected inflation goes up in the swap prices, or when the swap prices go up, that's an exaggeration. Expected inflation has gone up much less. For instance, when we look today, you look at something like a 5-year, you look at the 10-year expected inflation in the US in the last 12 months, it went up a lot. In the euro area, you may be worried, it's around 2.5%. We suggest that actually it's more like 2.25. About 20 of those basis points are liquidity shocks. Result 4. We can measure again, we've identified the whole system. I can go back to the fact that I have the data on every single one of these guys and figure out what is the price impact of one of them expecting higher inflation individually. And this is for the main dealer banks and the main hedge funds. And the first thing to note is that there's a lot of disagreement. There's a lot of heterogeneity here, and especially that there's really a handful of 5 or 6 hedge funds and 5 or 6 dealer banks that really drive most of the prices. There's a few guys whose beliefs are these? They're really of a few institutions at the left or the right. Again, a fairly interesting fact that may make you trust this more or trust less, but we are not talking about thousands of people. In the end, it's a few that drive these prices. Interestingly, though, or I don't know, cool result for someone like me or Raphael and others who've worked on this area, is that because I know the names of each of these people, I can't tell you, but I know who each of these hedge funds is, who each of these banks are. I can then go to Bloomberg survey where they call these banks and ask, what do you expect inflation to be? Remember, this is the actual trading of some guy who probably makes a lot of money. When Bloomberg calls, it's instead some chief economist who doesn't make that much money who tells them what expected inflation is. Maybe these are unrelated. They're just two different guys. Or maybe they just tell some nonsense to Bloomberg because they don't want to get them off their back. Whereas here, this is their life is on the line. This is where all their profit comes. Here's a striking result. because I can measure the expected inflation in your trading behavior and the expected inflation in the surveys, they actually correlate pretty well. So the people and the markets and the surveys actually match pretty well. Good news from Bloomberg, those surveys of when they call banks, those surveys of professionals turn out to seem to have pretty good information. At least they're not just saying stuff, they put their money where their mouth is. Conclude in my 15 minutes, we brought the first exhaustive data on who trades inflation swaps, the main market where we learn about expected inflation in the long run. And what we saw was that this is a very segmented market, where at the long horizons, dealers are really insurance companies, whereas at the short horizons, hedge funds and dealers are trading with each other, speculating with each other, if you want. We proposed 3 separate identification strategies that explain either variability of daily frequency, concentration constitutions, or the time series over time, and they gave very consistent results. Those results are the short horizon, the supply curve is steep, so liquidity shocks are the prices. But the long horizon supply curve is flat, and fundamentals account for a lot of the variation. We have a new measure of expected inflation, clean liquidity friction. We show that it's more anchored than the standard swap prices, and we found that the risk-neutral expectations inferred from market positions aligned fairly well with subjective expectations inferred from survey answers. Thank you very much, and it's Benjamin's time.
Yes, thank you for the presentation. Now, Benjamin Born, professor of macroeconomics from the Frankfurt School of Finance and Management, will present monetary policy in the age of social media, a Twitter-based inflation analysis.
Yeah, thanks a lot. Can you see my slides? Okay, perfect. Yeah, so thanks for inviting me to present this research. This is joint work with Rishabh Dalal, Nora Lamersdorf, and Sascha Steffen, all here at Frankfurt School. And I'm going to talk about monetary policy in the age of social media. And let me just stress up front, we still call this Twitter, even though it's now X, but everyone is confused. It might change at any time, so we stick with Twitter so everyone knows. I don't know, I don't have to show you that inflation, of course, increased a lot over the last couple of years. So here I show you the German CPI inflation. So everything I say today is about Germany, but the analysis is extendable to any country. Arguably, this was surprising to most policymakers, market participants, and consumers. And I think this reconfirmed the need for near real-time, on the one hand, measurement of inflation and inflation expectations, but on the other hand, also near real-time assessment of monetary policy effects and how maybe the ECB or the Fed can fight this inflation surge. So what we do in this paper, we basically have 2 parts to it, measurement and then the economics. So in terms of measurement, we use a new big data source to obtain consumers' real-time beliefs about inflation. Here, the Twitter data comes in. And we think this is a nice complement to the existing measures of inflation expectations, because on the one hand, you usually have the surveys of consumer expectations that are often small sample, they are costly, and they come with some time delay, so mostly monthly or even quarterly surveys. And on the other hand, you have market-based inflation expectations that are available in high frequency, but they arguably do not directly measure consumers' expectations, right? So we think this Twitter data offers a nice complement, and then we can use this high-frequency new index that we built to look at monetary policy and the effects on our index. So we can actually run daily local projections to look at whether monetary policy surprises by the ECB affect our index. So that's basically the paper in a nutshell. So let me be more specific on how we measure inflation and inflation expectations based on the Twitter index. So in terms of measurement, we proceed by 4 steps. So first, we go to the Twitter API and we download all German language tweets that we think are related somehow to prices and inflation. So here we don't distinguish between price and inflation because we realize consumers or the people on Twitter also often use prices and inflation really interchangeably. So we download everything related to prices and inflation. We start basically at the beginning of Twitter, and we now in the last iteration stopped in October 2023. So we download around 11 million tweets from more than 1 million users. But of course, there's a lot of stuff in that pure download. So you have bots promoting Bitcoins, you have all kinds of sales advertisements, you have price tweets unrelated to inflation and so on. So what we do in the second step, we use topic modeling to find tweets that are actually about prices or inflation. So in that step, we also remove duplicates, bots, etc. So then that already gives us a cleaner view, but then we also want to know whether the inflationary dynamics are up or down. So we need to classify the inflation tweets accordingly. And once we've done that, we can then aggregate this up to obtain a daily index. I don't have much time to go into the technical details, but let me just briefly give you a glimpse of these 4 steps. So with regard to the inflation topics, that we find is that our algorithms basically select 4 broad topics that are then itself constituting a different subtopic. So there's one more general inflation topic. So that's talking about prices, inflation. Expensive is one big word here, Germany. So remember, these are German language tweets. There's one big topic on energy prices. There's one big topic on inflation and policy, and then housing is also a topic that's very important. And you can imagine that the importance of these topics varies over time. So for example, with the Russian attack on Ukraine, the energy topic shot up considerably, right? So then we need to classify these tweets. Again, we go to a neural network, but we realize that we need to train this neural network on our specific task that we have. So what we do is we use ChatGPT via its API to create a training sample from our tweets, and then we train our neural network on that training sample. In the end, we obtain 375,000 tweets that talk about increasing prices and inflation, 87,000 down, and a lot of tweets where the algorithm cannot really decide. So in the end, we will discard this. So this is then the net index where we sum basically the up tweets minus the down tweets. And you can already see that our sample, of course, is dominated by the recent inflation surge here at the end of the sample. But what was reassuring to us that we also capture periods of downward price pressure. So in the 2015, that was around the time when the ECB implemented the APP, the index really captures also the downward price pressures. And we can compare it to the actual CPI numbers and to measures of inflation expectations for Germany. Unfortunately, the Bundesbank survey only starts in 2020. But what you can see here, so black is the index aggregated now to the monthly level. The blue line is the actual CPI developments in Germany, and the squares are inflation expectations from the Bundesbank survey. What you can see is that our index, first of all, basically runs ahead of the actual CPI numbers, but also the inflation expectation. But also interestingly, during the pandemic, where the CPI dropped massively, inflation expectations in the survey stayed roughly constant or didn't drop. Our index rather follows these inflation expectations. So we think we capture more the forward-looking nature rather than backward-looking. We're currently working on having the model determine whether a tweet is forward or backward-looking, but that's really tricky given the short text that we have. Yeah? We also look at different expectations that are more long-running, and we find the same picture. And then in the paper, we also look at forecasting models, at stub periods. What we really find is that there's information contained in our index that goes beyond what we have in surveys, in market-based expectations, and so on. Yeah. And then in the second part of the paper, we then take our index, which is essentially available at the second level or whatever the amount of the time dimension of the tweets are, but we aggregate it to the daily level, and then we run simple Jordan type local projections where we use monetary policy surprises computed by Altavilla as the ECB policy shocks. So you can interpret then the beta coefficient here, the beta H, as the response of the inflation index to a monetary policy response at horizon H, so here at day H after the surprise. To take out a little bit of the noisiness of the daily index, we use a backward-looking 7-day moving average to smooth out the impulse response a little bit. So this is the result from this baseline regression. So you regress our index on a monetary policy response or surprise, essentially. And what you get is that after about a week, the index turns negative. So there is a response about a week after the ECB's surprise announcement. In terms of magnitudes, you can interpret this as a 10 basis point monetary policy surprise induces our index to drop by about 30 points. But it takes a little bit of time. Partly that's due to our smoothing, but partly it's also because it seems like it takes some time to trickle through Twitter, basically. So there's still a bit of discussion at the beginning after a surprise. Why was that done? And so on. And then the response only turns negative after about a week. Now, we wanted to analyze this a bit further. So the next thing that we did was that we looked at positive and negative surprises separately. And we can do that because even in the later surge in inflation, where the ECB then at some point responded quite drastically, you still have up and down surprises available here. So let's look at this. So same impulse, so the same model, just separately having positive and negative shocks in there. And what we can see is that this response of our index is really driven by tightening surprises. So the black line, those are tightening surprises. The dashed line are easing surprises. They don't do anything here. It's really driven by these tightening surprises. And then, of course, the question is, okay, who is responding here really? So our prior was maybe it's journalists who comment on the ECB decision, and then it trickles through to private individuals, private households. Maybe companies respond differently. So what we do is we use the algorithm to produce separate indices for different participants on Twitter. So private individuals, media, businesses, economists, and so on. And what we find, and which surprised us a little bit, was that it's really private individuals that drive the response of the index and not so much media organizations, for example. And this maybe upfront may be hard to square with the evidence that we had for a long time from surveys that private individuals, households don't really pay much attention to what the ECB or the Fed is doing, right? But now with the recent surge in inflation, there's now research evidence coming in that during the surge, at least, households start paying attention to inflation announcements, to monetary policy decisions. So what we do is we now split the sample into this more calm inflation, low inflation period, and then the surge period. And if we do that, then we see that in this period where there was not much going on with inflation, rather rationally, households also didn't pay much attention. So the index doesn't really respond to these monetary policy surprises. But during the recent surge, this is where the index now also responds. And now, of course, that's a bit now difficult to disentangle. We've earlier found that tightening surprises are really what drives the index. But of course, that's also this period here of the inflation surge where you might have these strong tightening surprises. So it might be a bit of an entanglement here, but I think it squares very well with the evidence that, okay, during inflationary times, people pay more attention to this whole nexus of inflation and monetary policy, and that's really what we see in our index. So this is, of course, all very quick, and in the paper we do much more. We also look at regional indices because we know where the Twitter users are situated. We look at different special topic indices and so on. But just to give you the overall summary, so we constructed inflation expectation index from German tweets using natural language processing techniques. This index is available in real time and can be fine-tuned to the target group. It correlates strongly with actual inflation and consumer inflation expectations at the national and regional levels. And what I couldn't show you today, but what we show in the paper, it also improves forecasting accuracies. The index reacts to monetary policy announcement, but really only during the high inflation period since 2021. The index is negatively correlated with more discretionary consumption spending. So that's a part that I haven't talked about here, but we have some preliminary evidence in the paper. So overall, we think we won't replace the survey-based measures or the market-based measures with this, but I think it's a useful complement to the existing measures that we have here. So thanks a lot.
Okay. Now it's the Q&A portion. Just a quick reminder for people watching, if you have any questions you would like to ask the speakers, please type them into the Q&A and I can read them out. So first we have a question for Ricardo Reis. If there are different types of fundamental shocks, so for example, some fundamental shocks that mostly affect short-term inflation expectations and other fundamental shocks that mostly affect long-term inflation expectations, is this a problem for the identification?
No, not at all. But let me explain exactly what fundamental means here. So remember, all I observe, I'm thinking here of demand and supply functions, right?
Mm-hmm.
A fundamental in this market is what? It's anything that shifts all of demand and supply, all demands and all supplies, right? It's a fundamental in terms of affecting inflation, but it doesn't say that, for instance, the expectations of the pension funds are the same as the banks. It may shift some expectations more than others. And likewise, it may be that affects long-term and short-term in a correlated, uncorrelated, negatively correlated, whatever direction you want, okay? What I want to distinguish is those shifts, fundamentals should shift all demand and all supply, since after all, this is a market where you bet on inflation, from things that only shift supply or only shift demand. That's what I call liquidity frictions. So, but to be clear, what I call fundamentals could be expected inflation, rational, could be irrational beliefs of all players in this market, and could also be liquidity shocks, but I don't want to use that word, that affect all sides in this market, right? The definition of what is a fundamental is something that shifts everyone's behavior here. What I call liquidity is what shifts some behavior and not others. That is what a fundamental here is. Given it's a market where you're trading expected inflation, identifying the fundamental with a measure of expected inflation makes sense, but it could, by the way, be contaminated by shocks to others. But whether there's correlation between the short and the long term of the fundamentals, any correlation is allowed for, and this does not threaten identification in any way.
Okay. The next question is for Benjamin Born. Is there a high frequency price puzzle following the tightening, monetary policy tightening in your results? And does this puzzle disappear if you add oil price controls?
Yeah, that's an interesting idea, the price puzzle that we have in these VAR-based identification approaches. So we haven't tried that, but oil prices, they are available at high frequency, so we could add these controls. So I looked a little bit at the tweets after these ECB announcements. And of course, our shocks should be exogenous, but what we see, at least after the announcement for a day or two, there's a lot of Twitter discussion talking about the decision and the reasons for the decision. So it might be, if there's a tightening shock, then there's still a lot of chatter about high inflation because it's more backward looking at these decisions. And then the discussion turns. But I think it's a great idea to just run our local projections and including some energy price or oil price controls. Thanks.
Mm-hmm. Thank you. Now I have a couple questions for Ricardo. How should we think about the implications of the granularity that you find for policy and market design?
I don't know, meaning, so imagine that you learn, let's think about it a little bit as theorists if you want. Imagine that you learn that you have a market in which we're trading information, we're talking, and one of us speaks louder. Does that mean that, is that a problem or not a problem? Well, if the one who speaks louder is the most informed, maybe we should listen to him. If we're talking about inflation expectations here, maybe we should all shut up and listen to Benny here. He knows what he's talking about, and we should hear a lot of him. But we would find in this market, Benny dominates in our market for ideas, if you want. Maybe you think, no, I'd like to have everyone speak a little bit because I know Benny has his biases, Ricardo has his biases, you too, Hugh, and so I want really a sum of them. Fine, but why should this be a equally weighted sum? I mean, you should put more weight on some people who know what they're talking about and less weight on others, right? You know, the wonderful thing about markets is that they aggregate information, as Hayek said, and they reflect the views of the marginal guy, which often will be a weighted average of the different participants, right? We are finding that a few guys' voices have a stronger impact on prices. Is that a sign of inefficiency? Absolutely not, per se. It is a sign of understanding the IO of these markets. It means that, for instance, if you think that one particular big hedge fund, big player, becomes very biased, that could distort very much your prices. But of course, note, it is exactly that we're trying to do, because if only was only one hedge fund that developed some crazy view, then that will show up as what I call a liquidity shock. Now, the fact that a correlated shock between myself, Benny, and you, Hugh, all of us correlate, the fact that then it's Benjamin's view of it is the one that's reflected most in the price is not necessarily bad per se, or at least, I guess the find that I found at Granular would say that it's even more important to do the work that we do, to look at the fundamental of the liquidity, because it does show that the liquidity shocks of these pension funds, you really want to take them out because it's like 5 guys, or not 5 guys, because each of these funds may have many guys trading, but still.
Okay, thank you. Next is a question for Benny. How important is regional and local variation as a factor driving your measure of inflation expectations?
Yeah, thanks for the question. Ex ante, we thought there could be a nice kind of variation because West and East Germany are quite different still in their economic dynamics. But we don't find, at least for Germany, we don't find much local variation. What we are now looking into, because we have German language tweets, so we also have Switzerland, at least the German-speaking Switzerland in the sample. And inflation dynamics in Switzerland were very different to the ones in Germany. So we now want to understand maybe to see whether we can identify local variation, Germany versus Switzerland, but we haven't done so far. But in terms of like East, West, North, South in Germany, we just don't find much variation there. Mm-hmm. And also we can compare it to regional, also survey-based measures, and they are very highly correlated also at the regional level, at least in the recent search.
Mm-hmm. Yeah, thank you. Next is a pair of data questions. I suppose first for Benjamin Born. The question is, how did you get the tweets given the new policy of webscaping in X? Which API did you use? And then a related question is, have you seen a decrease in the volume since the new policies over the past year?
Yeah, so we don't do web scraping. We really use the Twitter API, and it was free until May or so. So until then, we could download, and we even had the idea of just having a daily index update, just run it automatically. But unfortunately now, even for researchers, it's costly. So in October, we did one update of the index. We paid for it essentially to use the API. And then in terms of like the reduced volume of tweets, we looked into that. So we see that over the summer, it decreased, but it also decreased a lot because bot activity went down. So at least during the summer, when we looked at it, Elon Musk's promise to also take care of the bots is there. So we checked this out. This is not driving our index, at least this reduced activity. Yeah.
Okay. Thank you. And then Ricardo Reis, question is, if you could speak a little bit more about the data set you use, how frequently it comes out, and is it something that policymakers could actually use to nowcast changes in inflation expectations?
The data is built by policymakers, meaning essentially starting with 2010 reforms of markets, every time you sell an inflation swap, you have to report to the regulator. So every single contract is there. I have all the ones traded in London because I had access to it from the Bank of England. The ECB has massive, even bigger of every contract traded, no, not bigger, actually smaller because London is the big market for swaps, of everyone traded. This is in daily. I have access to the data daily. I could measure this for yesterday, actually. It's a lot of work. It's billions and billions of contracts that get traded. But part of why the Bank of England, I think, was happy that we were doing this work is that it takes enormous amount of work. It took us almost a year to clean the data and make it usable. Now the Bank of England has access to it at a daily frequency to what's going on to these prices and can therefore use it for regulatory and for inflation purposes if you want. But the data is essentially almost the universe of all of these swaps traded. It is the regulators that have it. And they now, at least at the Bank of England, they now can produce this. One of the co-authors, Rob Check, now produces this every day for policymakers to look at. Can I ask a question for Benny? Sorry, can I squeeze in one? Are you?
Sure. Go ahead.
So huge question in expectations, and perhaps if you want the fundamental question is, do expectations say drive inflation? And the reason why it's almost an unanswerable question is that these are both endogenous objects. Inflation drives expectations, and expectations drive inflation, as they should in some ways. So when we say do expectations drive inflation, I think what we'd like to have is some exogenous change in expectations and see whether inflation changes afterwards, right? Which again, in rational expectations, this is impossible. There is no such thing. But we know that there's animal beliefs or animal spirits, Keynes called them, and sometimes expectations change. It's very hard to identify those, but since you have daily data, could you, using, say, fundamentals like CPI release and others, try to use from your measure, extract what seem like crazy changes in expectations? Nothing to do with any data, no fundamental, just because Twitter or X sometimes goes in some crazy rants for weird reasons. It would be very interesting if you saw that those truly expectation shocks actually drive inflation, since that is a huge question and a question that dominates even the debate in the last 2 years, with a lot of papers unconvinced in my view, saying expectations drive the inflation, don't drive inflation, and just going around in circles around the fixed point.
No, that's a great idea. So what we have looked at so far are like publication dates of like inflation numbers, other macroeconomic variables. And of course, they drive the index to a certain extent, naturally. But we haven't looked at like specific events that are known to have these massive impacts, and hunting for those and then looking at the question that you have. I think we should do, or it's a different paper maybe, but
absolutely,
it's very interesting.
I think it'd be great. Like if you see that whenever people start talking about, Beyonce or Taylor Swift, or whatever, and that has nothing to do with fundamentals on inflation, but that somehow squeezes out the inflation news and therefore ends up being a shock to the inflation. That's the kind of thing that I would like.
No, that's a great
fundamental
idea.
question.
Yeah, thanks.
Okay. We have another question for Benjamin Bourne. You pointed out that your index leads expected in actual inflation, especially during the inflation surge in 2021, 2022. However, in 2015, when the actual inflation rate drops, your index drops at the same time rather than leading it. Do you have a explanation for why the timing changes in this one episode?
No, I don't have a good explanation. So it's true. There, the timing is more like synchronous. It might be that these were times where inflation was not so salient. People were not paying too much attention or looking forward. I think here our hope is once the language model can identify a little bit better, is this tweet forward-looking or backward-looking, we can then look at these episodes separately and understand better what we have. So far, we don't have a good explanation for it.
Okay.
But maybe just as one more sentence to it, it's also that this drop, there are way fewer tweets during that time about inflation than what we have in the search. I guess there is more informational content available now in these periods where a lot of people have talked about inflation.
Mm-hmm. Okay. Well, thank you to both speakers for your giving these presentations and answering questions. That's all the time we have, and I hope everyone has a wonderful day or evening if you're in Europe.
Thank you, everyone.
Thanks a lot.